the $234,000 retirement community financial mistake. If you're over 60 and considering a move to a retirement community, there's one financial mistake that could quietly drain up to $234,000 from your nest egg, and most retirees never see it coming. Let me repeat that. $234,000 lost simply by overlooking a critical detail in your retirement community contract. In my 3 decades of guiding affluent seniors through successful retirement transitions, I've seen this devastating error again and again. The wealthiest retirees I work with all take careful steps to avoid it, yet many well-prepared Americans still fall into this costly trap. The longer you wait to understand this, the more vulnerable your savings become, especially as healthcare costs and inflation continue to rise. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your specific situation. And remember, past performance doesn't guarantee future results. Today, I'm going to reveal exactly what this $234,000 mistake is, how to spot it before you sign anything, and the proven strategies my clients use to protect their wealth and legacy. By the end of this video, you'll know how to secure your financial future and avoid becoming another cautionary tale. But first, let me share the single most overlooked clause that could change everything. Part 1. The hidden cost lurking in retirement community contracts. Let's start with a reality that's quietly impacting thousands of retirees every single year. You've spent decades working hard, saving diligently, and making smart choices to build a comfortable nest egg. Now, as you approach, or perhaps have already entered, your 60s and beyond, you're likely considering the next chapter: where you'll live, how you'll maintain your independence, and how you'll ensure your savings last as long as you do. For many affluent American seniors, the idea of moving into a retirement community seems like an ideal solution. It promises security, social connection, and a maintenance-free lifestyle. But beneath the glossy brochures and friendly tours, there's a hidden financial danger that could cost you up to $234,000, or even more, over the course of your retirement. Let me repeat that because it's so important. There's a single mistake buried in many retirement community contracts that has cost some retirees as much as $234,000 in lost savings, unexpected fees, and missed opportunities. In my 30-plus years of helping seniors navigate these crucial decisions, I've seen this scenario play out far too often. It's not just a theoretical risk, it's a real documented issue that is quietly eroding the financial security of retirees who thought they had done everything right. Now you might be thinking, I've read the contracts, I've asked the right questions, I'm careful with my money. And that's exactly what many of my most careful clients have said before they discovered the fine print that changed everything. The truth is, retirement community contracts are some of the most complex documents you'll ever sign. They're filled with legal language, escalating fee schedules, and clauses that can shift over time. Even savvy, experienced investors can miss the crucial details that turn a comfortable retirement into a stressful financial drain. Let's look at the numbers because the statistics are truly staggering. According to a recent national survey, the average entrance fee for a continuing care retirement community, CCRC, in the United States is now over $329,000. Monthly fees can range from $3,500 to $7,000, depending on the level of care and amenities. But here's the part most people miss. Nearly 43% of residents reported being surprised by additional fees or unexpected charges within the first 3 years of moving in. And perhaps most alarming, a study published by the National Investment Center for Seniors Housing and Care found that the average retiree underestimates their total out-of-pocket retirement community costs by $117,000 over a 10-year period. That's not just a budgeting error, that's a life-changing sum of money. For many, it means dipping into investment accounts earlier than planned, paying more in taxes due to higher withdrawals, or even sacrificing the legacy they hope to leave to children and grandchildren. And these numbers don't even account for the opportunity cost of locking a large portion of your savings into non-refundable or partially refundable entrance fees. In fact, a recent case I worked on involved a couple who thought they were making a prudent move by paying a $400,000 entrance fee, only to discover that their contract allowed the community to retain up to 70% of that amount if they needed to leave within the first 5 years. That's $280,000. Gone, just like that. Let me pause here and emphasize, this is not meant to scare you, but to empower you. Most retirement communities are reputable, and many retirees are happy with their choice. But the financial landscape has changed dramatically over the past decade. Healthcare costs are rising at an average rate of 4.7% per year, according to the Centers for Medicare and Medicaid Services. Inflation is eroding purchasing power, and investment returns, while historically strong, are never guaranteed. Every dollar you lose to hidden fees or unfavorable contract terms is a dollar that could have supported your lifestyle, covered unexpected medical expenses, or been passed on to your loved ones. Here's another reality check. Most Americans over age 60 underestimate their life expectancy by nearly 7 years, according to the Society of Actuaries. That means your money needs to last longer than you might think. And if you're like many of the conservative, risk-averse retirees I work with, you value stability and predictability above all else. The last thing you want is a nasty financial surprise at a time in life when flexibility is limited. Let's talk about some of the specific financial challenges that come with retirement community living. First, there's the entrance fee itself. Is it fully refundable, partially refundable, or non-refundable? What happens if you need to move out for health reasons or to be closer to family? Many contracts include declining balance clauses, where the refundable portion decreases by a set percentage each year. For example, a $300,000 entrance fee might lose 10% of its refund value each year, meaning that after 5 years, you or your estate could get back as little as $150,000. That's a $150,000 loss, money that could have remained invested and working for you. Second, there are monthly service fees, which can increase over time. In my experience, I've seen fees rise by as much as 5% per year, far outpacing Social Security cost of living adjustments, which typically average around 2% annually. Over a decade, that difference can add up to tens of thousands of dollars in unexpected costs. And if you require higher levels of care, such as assisted living or skilled nursing, those fees can skyrocket to $8,000 or even $10,000 per month. Third, there are healthcare surcharges and ancillary fees that are often buried in the contract. These can include charges for medication management, transportation, guest meals, or even participation in certain activities. I've seen retirees who budgeted carefully for their monthly expenses, only to be blindsided by an extra $500 to $1,000 per month in optional fees that quickly became essential. And finally, let's address the emotional and psychological toll of these financial surprises. In my decades of experience, I've witnessed how unexpected costs can create anxiety, strain family relationships, and even force difficult decisions about care or lifestyle. The wealthiest and most successful retirees I know are those who go in with their eyes wide open, armed with the right questions and a clear understanding of the risks. Let me be crystal clear. This is educational content, not personalized financial advice. Every retirement community is different, and your personal situation is unique. That's why it's absolutely critical to consult with a qualified financial advisor who understands the complexities of senior living contracts and can help you evaluate the true long-term costs. So, why does this problem matter even more after age 60? Simply put, the margin for error shrinks as we get older. You have less time to recover from a major financial setback, and your ability to generate new income is often limited. Every dollar lost to hidden fees or poorly structured contracts is a dollar that's gone forever, potentially robbing you of financial security, peace of mind, and the legacy you've worked so hard to build. I want you to remember this. The sooner you identify and address these hidden risks, the more options and flexibility you'll have. Every month you delay could mean another costly fee or missed opportunity to protect your savings. I've seen too many seniors wait until it's too late, only to find themselves trapped by contract terms they didn't fully understand. But here's what most financial advisors won't tell you. There's a proven conservative approach to evaluating and negotiating retirement community contracts that can dramatically reduce your risk, preserve your capital, and give you the confidence to move forward. It's not about being aggressive or taking unnecessary risks. It's about asking the right questions, understanding the true costs, and building a plan that puts your interests first. So far, we've covered the staggering financial risks, the shocking statistics, and the reasons why this issue is more urgent than ever for retirees like you. But the solution is simpler than you think, and it starts with a foundation that most people, and even many advisors, completely overlook. The solution is simpler than you think, but most people get it wrong. Part 2. The Proven Foundation: How Savvy Retirees Protect Six Figures in Retirement Community Decisions. Now that we've brought those hidden risks and shocking numbers into the light, let's shift to what you can actually do about it. If you're feeling a bit overwhelmed by the complexity and sheer magnitude of potential losses, let me reassure you, there is a clear, proven approach that can help you sidestep the $234,000 retirement community mistake. Over the past 30 years, I've walked hundreds of retirees through this exact process, and I can tell you, when you build your decision on the right foundation, you gain control, clarity, and real peace of mind. So, what's the core solution? It's not about finding a secret loophole or outsmarting the system with risky maneuvers. Instead, it's about implementing a structured, conservative, and highly informed due diligence process, one that's tailored specifically for the unique needs of seniors with substantial retirement savings. This approach is designed to protect your principal, maximize your flexibility, and ensure you're not caught off guard by hidden fees, escalating costs, or unfavorable contract terms. Let me repeat that important point. The most successful retirees I work with follow a disciplined, step-by-step due diligence process before signing any retirement community contract. This isn't just a casual review or a quick scan of the fine print. It's a comprehensive evaluation that covers every angle: financial, legal, tax, and even healthcare related. By taking the time to do this up front, you not only avoid costly mistakes, but also put yourself in a position to negotiate better terms and preserve your legacy for years to come. Why does this work so well for seniors, especially those with significant assets? The answer is simple. You have more to lose and less time to recover from a financial setback. When you're in your 60s, 70s, or beyond, every dollar counts because those dollars represent security, independence, and the ability to handle the unexpected. Unlike younger buyers, you may not have decades to rebuild your savings if something goes wrong. That's why a conservative, detail-oriented approach is not just smart, it's essential. Let me share a story from my own experience. A few years ago, I worked with a couple in their early 70s who were excited about moving into a high-end retirement community. They had done well for themselves, with over $1.2 million in retirement savings, and they wanted the peace of mind that comes with a maintenance-free lifestyle. The entrance fee was $350,000, with monthly charges of $5,200. On the surface, everything looked reasonable, but before they signed, we walked through my due diligence checklist, line by line, question by question. It turned out their contract included a declining refund clause. If they left within the first 5 years, they would lose 12% of their entrance fee each year. That meant if they needed to move out after just 3 years, for health reasons or to be closer to family, they would forfeit $126,000 of their initial investment. When we ran the numbers, they realized that, given their health history, there was a realistic chance they might not stay for the full refund period. Because they caught this detail before signing, they were able to negotiate a modified contract with a flat 90% refund, even if they left early. That single step protected over $100,000 of their savings. Here's another example. I once worked with a widow in her mid-60s who was considering a community with a seemingly attractive $275,000 entrance fee and monthly costs of $4,600. She was sharp, careful, and had managed her finances well for decades. But when we reviewed the contract, we discovered a healthcare surcharge clause that could raise her monthly fees by up to $1,200 if she required even minor additional care. By asking the right questions and consulting with a qualified elder law attorney, something I always recommend, she was able to negotiate an annual cap on surcharges, limiting her risk and preserving her cash flow. Over 10 years, that decision saved her over $80,000 in potential extra costs. These stories aren't outliers. They're the result of a methodical approach that anyone can follow, regardless of background or financial sophistication. The key is to treat the retirement community decision with the same seriousness and rigor you'd use for any major investment. After all, committing hundreds of thousands of dollars to a community is often the single largest financial decision you'll make in retirement, outside of your primary residence. So, what exactly does this core solution look like in practice? It starts with a comprehensive review of the contract, not just the summary pages, but every clause that impacts your finances, your health care, and your estate. You want to know, in plain English, the answers to questions like, is my entrance fee fully refundable, partially refundable, or non-refundable? How are monthly fees structured, and how often can they increase? What happens if I need to move out earlier than planned? Are there surcharges for health care, meals, transportation, or guests? How does the community handle transitions to higher levels of care, and what are the costs involved? The due diligence process also includes a careful analysis of your own financial situation. Many retirees find it helpful to run what-if scenarios. What if I live longer than expected? What if I need expensive health care? What if the community raises fees faster than inflation? By stress testing your plan, you can identify potential weak points and address them before they become problems. And let's not forget the importance of involving professionals. In my 3 decades of experience, I've seen the best outcomes when retirees consult with both a qualified financial advisor and an elder law attorney before signing any contract. These experts can spot red flags, explain complicated language, and help you understand the tax and estate planning implications of your decision. For example, did you know that some entrance fees may be partially deductible as a prepaid medical expense, potentially saving you thousands of dollars in taxes? Or that certain contract structures can impact your eligibility for Medicaid or VA benefits down the line? These are details that most people, and even some advisors, completely overlook. This is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your specific situation and never rely solely on general information when making decisions that affect your future. Now, why is this approach so effective for seniors, especially those who are risk-averse and value security? Because it puts you in the driver's seat. Instead of reacting to surprises after the fact, you're proactively identifying risks and negotiating terms that work in your favor. You're protecting your principal, managing your cash flow, and ensuring that your retirement lifestyle is built on a solid, predictable foundation. And perhaps most importantly, you're preserving your options, so if your needs or preferences change, you have the flexibility to adapt without suffering a major financial hit. Let me emphasize, the sooner you start this process, the more leverage you have. Retirement communities want to fill their units, and they're often willing to negotiate if you ask the right questions and demonstrate that you're an informed, serious buyer. Every month you delay, you risk losing bargaining power, or worse, getting locked into a contract that doesn't serve your long-term interests. So far, we've identified the problem, explored the risks, and introduced the core solution that has helped countless retirees protect their savings and their peace of mind. But understanding the strategy is just the beginning. Now let me show you exactly how to implement this step by step so you can move forward with confidence, avoid the $234,000 mistake, and secure the retirement lifestyle you deserve. But before we dive in, here's the insider secret that changes everything. Part 3, Step by Step. How to safeguard your retirement savings before signing that contract. Now that you understand the hidden risks and the proven foundation for protecting your retirement wealth, let's get practical. I want you to walk away from this video with clear, actionable steps you can follow. Steps that, in my 30-plus years of working with retirees, have consistently helped my clients avoid six-figure losses and secure their financial future. Remember, this is educational content, not personalized financial advice. You should always consult with a qualified financial advisor for your specific situation. But if you follow these steps, you'll be far ahead of most people entering a retirement community. Let's break this down into a simple 5-step process. You can start right now. I'll provide exact numbers, timeframes, and the reasoning behind each move. Because when you see the details, you'll understand how powerful this approach really is. The first step is to obtain and thoroughly review the full unabridged contract from the retirement community. Don't settle for a summary or a sales brochure. I've seen too many retirees trust the glossy handouts only to be blindsided by the fine print. Ask the community representative directly for the complete legal document. If they hesitate or stall, that's a red flag in itself. Give yourself at least 14 days to review the contract at home, away from sales pressure. In my experience, the most successful retirees take a minimum of 2 weeks to read and annotate every section, highlighting anything that seems unclear or potentially costly. If you're unsure about legal language, make a note of it. Don't rush this process. Every day you invest now could save you tens of thousands of dollars down the road. The second step is to create a detailed cost projection spreadsheet that covers at least 10 years of residency. Start by entering the entrance fee, let's say $350,000, which is the current national average for a mid-tier continuing care retirement community. Next, list the monthly service fees. For example, if the base fee is $4,500 per month, that's $54,000 per year. But don't stop there. Add a 4% annual increase to those fees, which is slightly below the industry average of 4.7%, but provides a conservative estimate. Over a decade, that $54,000 per year could rise to more than $80,000 per year by year 10. Now, factor in healthcare surcharges, which can add $800 to $1,500 per month if you require assisted living or skilled nursing. Include at least $10,000 per year as a contingency for these surcharges. When you total these figures, you'll have a realistic, eye-opening sense of the true long-term costs. Many of my clients are shocked to see how quickly expenses can compound, but this clarity is what empowers you to make the right choice. The third step is to analyze the refundability and exit clauses in detail. For instance, if you're paying a $350,000 entrance fee, is it fully refundable, partially refundable, or non-refundable? I've seen contracts where the refund drops by 10% each year, so after 5 years, only 50%, or $175,000, would be returned to you or your estate. Some communities offer a flat 90% or even 100% refund, but you must check for strings attached, such as requiring the unit to be reoccupied before any refund is paid out. Ask the community for a written, itemized explanation of their refund policy. Don't be afraid to request a sample payout schedule. In my experience, the wealthiest retirees I work with always verify these details in writing before moving forward. This step alone can protect $100,000 or more of your principal in the event you need to move, or if your circumstances change unexpectedly. The fourth step is to consult with 2 critical professionals, a qualified financial advisor and an elder law attorney. Schedule these meetings within 30 days of receiving your contract. Your financial advisor should stress test your retirement income plan using the cost projections you created. For example, if your Social Security provides $42,000 per year and your required withdrawals from IRAs and 401ks are projected at $60,000 per year to cover community costs, your advisor can help you optimize withdrawals for tax efficiency, potentially saving you $5,000 to $10,000 annually in unnecessary taxes. Your elder law attorney will review the contract for clauses that could impact your estate, Medicaid eligibility, or your rights if you need to move out. In my experience, a thorough legal review costs between $1,500 and $3,000, but it's a small price to pay compared to the $234,000 mistake you're trying to avoid. The fifth and final step is to negotiate, yes, negotiate, before you sign. Most retirees don't realize that many retirement communities are open to adjusting terms, especially if you're an informed, proactive buyer. You might be able to secure a higher refund percentage, a cap on annual fee increases, or a healthcare surcharge limit. I've helped clients negotiate an extra 5% refund on a $400,000 entrance fee, which put $20,000 back in their pocket. The key is to approach this conversation with confidence and data. Present your cost projections and ask for specific concessions. If you're not comfortable negotiating, your attorney or advisor can often help. Let's pause and recap what we've covered so far. First, you're obtaining and reviewing the full contract. No shortcuts. Second, you're building a detailed cost projection spreadsheet for at least 10 years using real numbers and conservative estimates. Third, you're analyzing refundability and exit clauses to protect your principal. Fourth, you're consulting with a qualified financial advisor and an elder law attorney within 30 days. And fifth, you're negotiating for better terms using your research and professional support as leverage. I want to address some common concerns that come up during this process because I know how important it is to feel secure and confident. Many seniors worry about rocking the boat or offending the community by asking too many questions. Let me assure you, in my 3 decades of helping retirees, I've found that the most reputable communities actually appreciate informed buyers. They know you're serious, and they're more likely to treat you with respect. Another concern is the cost of professional advice. While $1,500 to $3,000 for legal and financial reviews may seem steep, remember that you're potentially protecting hundreds of thousands of dollars and your peace of mind. Some retirees also worry about timing, how long this process will take. In my experience, the entire due diligence and negotiation process typically takes 45 to 60 days from start to finish. That's a short window compared to the decades you'll spend in your new home. Taking the time now is a no-risk way to increase your income security and protect your legacy. Let me repeat, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation before making any decisions. No strategy can guarantee specific results, but historically, retirees who follow this disciplined approach have avoided the most expensive mistakes and enjoyed greater financial security. So, what have we covered in this section? We've walked through the 5 essential practical steps you can follow to protect your retirement savings before signing a retirement community contract. We've used real numbers, realistic timeframes, and a conservative approach that prioritizes your security. But before you take action, you need to avoid these critical mistakes that have cost retirees hundreds of thousands of dollars. Part 4, the costliest retirement community mistakes, and how to spot them before it's too late. Let's take a moment to breathe. You've already learned how to approach retirement community contracts with the same care you'd use for any major financial decision. But even with a solid process, there are several all too common mistakes that can quietly sabotage your financial security. In my 30-plus years of helping retirees, I've seen these errors cost individuals and couples not just money, but peace of mind, flexibility, and even the ability to leave a legacy for loved ones. If you remember nothing else from this entire series, let it be these pitfalls, because the sooner you recognize them, the more power you have to protect yourself. This is educational content, not personalized financial advice. Please consult a qualified financial advisor for your specific situation. And remember, there are no guaranteed outcomes in retirement planning, but learning from others' mistakes is one of the safest ways to increase your odds of success. The first and perhaps most expensive mistake is failing to understand the refundability of your entrance fee. I can't tell you how many times I've reviewed contracts where the refund schedule was buried deep in the fine print or explained in confusing legal language. Many retirees assume that if they pay a $350,000 entrance fee, they or their estate will get it all back if they move out or pass away. But historically, most contracts are far less generous. For instance, I recently worked with a client who thought she'd receive a 90% refund on her $280,000 fee. In reality, her contract included a declining balance clause. For every year she stayed, the refundable amount dropped by 10%. When she needed to move after just 3 years due to a health crisis, her estate was entitled to only 60%, a loss of $112,000. Warning sign: if the contract uses phrases like declining refund, amortization, or reoccupancy required, ask for a clear written explanation of exactly how much you or your heirs will receive and under what conditions. If you can't get that answer in writing, that's a major red flag. The second costly mistake is underestimating the impact of escalating monthly fees and hidden surcharges. Many communities advertise a base monthly fee, let's say $4,800, that covers housing, utilities, and basic services. But what's often left out of the glossy brochures is how quickly those fees can rise and what isn't included. In my experience, monthly costs typically increase by 4% to 6% per year, much faster than the Social Security cost of living adjustment, which has averaged just 2.6% over the past decade. Over 10 years, that $4,800 monthly fee could balloon to over $7,100, adding up to $276,000 in cumulative payments, $90,000 more than many retirees expect. And that doesn't include add-ons like meal plans, transportation, or healthcare surcharges, which can tack on another $500 to $1,200 per month. Warning sign: if the contract doesn't specify a cap on annual increases, or if certain services are labeled as optional but are functionally necessary, ask for a detailed, itemized list of all potential charges. If you're told, "Don't worry about it, nobody ever pays that much," take that as a cue to dig deeper. The third pitfall is neglecting to consider the cost and logistics of transitioning to higher levels of care. Many seniors choose a retirement community because of the promise of continuum of care, the idea that you can move seamlessly from independent living to assisted living or skilled nursing if your health needs change. But the reality is that these transitions can come with substantial financial and emotional costs. I've seen cases where moving from independent living to assisted living increased monthly fees from $5,000 to $9,000 overnight, a $48,000 annual jump. Worse, some contracts require you to pay a new entrance fee or forfeit your refund if you move within the same community. Warning sign: if the contract is vague about costs for assisted living or skilled nursing, or if there are separate agreements for each level of care, insist on seeing those documents before you sign. Run the numbers for a worst-case scenario. What would you pay if you needed the highest level of care for 3 to 5 years? If the answer isn't clear, you could be exposing yourself to six-figure surprises. The fourth mistake, one that's become increasingly common in recent years, is failing to protect yourself from financial scams and high-pressure sales tactics. I've seen thousands of seniors approached by aggressive marketers who promise limited-time deals, guaranteed returns, or exclusive benefits if you sign quickly. These tactics are designed to rush your decision and bypass your due diligence. Sometimes the communities themselves are reputable, but the salespeople are compensated on commission and have every incentive to gloss over the details. In other cases, the entire operation is a scam designed to collect large deposits and disappear. According to the Consumer Financial Protection Bureau, seniors lose more than $3 billion annually to financial scams, and retirement community deposits are a growing target. Warning sign. If you're pressured to sign before you've had time to review the contract with an attorney and advisor, or if you're asked to wire funds to an unverified account, stop immediately. A reputable community will always give you time and transparency. If something feels off, trust your instincts and walk away. Let's pause and recap. So far, we've discussed 4 of the most expensive and common retirement community mistakes: misunderstanding refundability, underestimating escalating fees and surcharges, overlooking the true cost of higher levels of care, and falling victim to scams or high-pressure sales. Each of these errors can cost you tens or even hundreds of thousands of dollars, and they all share one thing in common. They often result from a lack of clear information and a rush to sign. Now let me share some warning signs that should always prompt you to slow down and seek professional advice. If a community refuses to provide a complete, written contract for review, that's a major red flag. If you can't get a clear, itemized estimate of all monthly and annual costs, including healthcare and optional services, be wary. If the refund policy is explained only verbally, or if the salesperson discourages you from involving your family or advisors, walk away. And if the deal sounds too good to be true, such as guaranteed returns or no risk whatsoever, remember that no legitimate investment or housing decision comes without some element of risk. You might be wondering, how do I protect myself from these pitfalls, especially when the process feels so overwhelming? The answer is to slow down, ask tough questions, document everything, and always involve qualified professionals. The most successful retirees I work with are those who insist on clarity, transparency, and time to make decisions. They don't let pressure, excitement, or fear cloud their judgment. Let me repeat for emphasis. This is educational content, not personalized financial advice. Your situation is unique, and you should always consult with a qualified financial advisor before making any major decisions. But by learning from the mistakes of others, you're already taking a conservative, safety-first approach that can help preserve your wealth and your peace of mind. So far, we've uncovered the most common and costly mistakes and the warning signs that can help you avoid them. Once you steer clear of these traps, you open the door to advanced strategies that most people never learn. These are the techniques that can help you optimize your contract, reduce your taxes, and even enhance your legacy. Once you avoid these traps, you can access advanced strategies that most people never learn. Part 5. Advanced Strategies. How to optimize your retirement community decision and preserve more wealth. Now that you know the most expensive pitfalls and how to spot them, let's go one level deeper. In my 30-plus years of helping affluent retirees navigate retirement community contracts, I've seen that the truly successful ones, those who not only avoid costly mistakes but actually enhance their financial position, use a handful of advanced strategies that most people never even hear about. These aren't risky maneuvers or loopholes. They're proven, conservative techniques that can put tens of thousands of dollars back in your pocket, reduce your tax bill, and even strengthen your legacy for your loved ones. This is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your specific situation before making any decisions. These strategies are designed to help you maximize your benefits in a safe, transparent, and compliant way. Let's start with one of the most underutilized strategies: leveraging the medical expense tax deduction for entrance fees and monthly payments. Many seniors don't realize that a portion of your entrance fee and monthly fees may be considered a prepaid medical expense under IRS rules, especially in continuing care retirement communities, CCRCs, that provide guaranteed access to higher levels of care. Historically, the IRS has allowed residents to deduct a percentage, often between 30% and 40%, of their entrance fee and ongoing monthly payments as a qualified medical expense in the year the payment is made. For example, if you pay a $350,000 entrance fee and your community certifies that 35% is allocable to future medical care, you could potentially deduct $122,500 as a medical expense in the year you move in. If your monthly fees are $5,000 and 35% is deemed medical, that's another $21,000 per year in deductible expenses. For many retirees, this deduction can offset required minimum distributions from IRAs or 401ks, lowering your taxable income and, in some cases, reducing your tax bill by $10,000 to $30,000 in a single year. The key is to request a written statement from the community specifying the deductible percentage and to work closely with your tax advisor to document and claim the deduction correctly. I've seen clients miss out on this benefit simply because they didn't know to ask. The second advanced strategy involves optimizing your withdrawal sequence for tax efficiency and cash flow stability. Most retirees default to withdrawing from taxable brokerage accounts first, then tapping IRAs, 401ks, or Roth accounts as needed. But when you're facing large, lump sum payments, such as a $350,000 entrance fee or escalating monthly costs, it pays to coordinate withdrawals for maximum tax advantage. For example, you might fund the entrance fee by taking a combination of IRA distributions and long-term capital gains, carefully staying below key income thresholds to avoid higher Medicare premiums or triggering the 3.8% net investment income tax. If you're married and both over 65, your standard deduction is $32,300 for 2024, and you may be able to offset taxable withdrawals with the medical deduction we just discussed. In one case, I helped a couple structure their withdrawals so that their effective tax rate on the entrance fee was under 8%, saving them over $18,000 compared to a typical withdrawal sequence. The timing and source of each withdrawal matter greatly, especially when large medical deductions are available. This is where a qualified financial advisor with expertise in senior planning can make a substantial difference. A third sophisticated technique is using a trust or gifting strategy to protect assets and enhance your estate plan. Many affluent retirees are concerned about preserving assets for heirs or charitable causes, even after moving into a retirement community. Depending on your state and the structure of your contract, it may be possible to fund the entrance fee from a revocable living trust or to make strategic gifts to family members before committing large sums to the community. For example, if your contract specifies a non-refundable or partially refundable entrance fee, you might choose to gift a portion of your assets, say $17,000 per year per recipient, which is the 2024 annual gift tax exclusion, prior to making the payment. This can reduce your taxable estate and ensure that some wealth is transferred directly to your children or grandchildren rather than being absorbed by the community in the event of an early move-out or unexpected health event. In other cases, establishing a trust can provide creditor protection, streamline estate settlement, and ensure that any refundable portion of your entrance fee is distributed according to your wishes. These strategies require careful legal and tax coordination, but they can provide significant peace of mind and long-term benefits. Let's pause and recap these advanced strategies. First, maximizing the medical expense deduction for both entrance and monthly fees. Second, optimizing your withdrawal sequence for tax efficiency and cash flow. And third, using trusts and gifting to protect your legacy and align with your estate planning goals. Each of these techniques can be tailored to your unique situation, and together they can help you keep more of your hard-earned wealth working for you and your family. I want to touch briefly on a bonus optimization that many retirees overlook: negotiating for rate locks or caps on annual fee increases. While not all communities will agree, some are willing to offer a cap, say 3% per year on monthly fee increases in exchange for a larger entrance fee or a longer commitment. In my experience, locking in a lower annual increase can save you $30,000 to $50,000 over a decade compared to uncapped fees that rise with inflation or healthcare costs. If you're in a strong financial position and willing to negotiate, this is a conversation worth having with the community's management team. I want to emphasize that none of these strategies are about chasing risky returns or making aggressive bets. Instead, they're about using the existing rules and options to your advantage, protecting your principal, reducing your tax burden, and ensuring that your retirement community experience is as financially secure as possible. The most successful retirees I work with are those who plan ahead, ask the right questions, and use every available tool to optimize their outcome. Let me repeat, this is educational content, not personalized financial advice. Every situation is different, and you should always consult with a qualified financial advisor and tax professional before implementing any advanced strategy. The window for these techniques is often time-sensitive. Tax years, contract deadlines, and regulatory changes can all impact your options. The sooner you take action, the more flexibility and control you'll have. So far, we've covered the most powerful ways to optimize your retirement community decision, strategies that can save you tens of thousands of dollars, minimize taxes, and strengthen your legacy. But as with any plan, timing is everything. Implementing these strategies in the right order and at the right time can mean the difference between success and disappointment. The key to success is getting your timing exactly right. Part 6. Your 90-day implementation timeline, the exact sequence for a secure retirement community move. Now that you've learned the advanced strategies for optimizing your retirement community decision, let's talk about something just as critical: timing and sequence. In my 30-plus years guiding retirees through these complex transitions, I've seen that even the best strategies can fall short if they're not implemented in the right order, with the right deadlines. The window for negotiation, due diligence, and tax optimization is often much shorter than people realize. That's why I want to walk you through a clear step-by-step 90-day timeline so you know exactly what to do, when to do it, and how to avoid the costly mistakes that can occur when things are rushed or left to chance. Let me remind you, this is educational content, not personalized financial advice. Every situation is unique, and you should consult with a qualified financial advisor and attorney before making decisions. But by following this proven timeline, you'll be in the strongest possible position to protect your savings, optimize your tax benefits, and secure your legacy. Let's start with the first 30 days, which are all about gathering information and laying the groundwork. As soon as you begin seriously considering a retirement community, whether you've taken a tour, received a contract, or just started your research, set aside time for a thorough review. Request the full, unabridged contract and all related fee schedules. Don't accept summaries or verbal explanations. Insist on the complete legal documents. Allocate at least 2 weeks for this process and use a highlighter or sticky notes to flag anything you don't understand or that seems unclear. During this period, begin assembling your financial documents, recent tax returns, Social Security statements, investment account statements, and any estate planning documents you have. This will make the next steps much smoother and faster. By day 15, schedule initial consultations with a qualified financial advisor and an elder law attorney. These professionals are your safety net. They can spot hidden risks, explain complex language, and identify opportunities for negotiation or tax savings. I recommend booking these appointments early, as good advisors and attorneys often have waiting lists of 2 to 3 weeks. If you're married or have adult children involved in your planning, invite them to join these meetings so everyone is on the same page. By day 21, you should have a list of key questions for the community, such as, how is the entrance fee refunded? Are there caps on annual fee increases? What are the costs for higher levels of care? And is there a written statement on medical expense deductibility? Aim to get all answers in writing by the end of the first 30 days. Moving into the 30 to 60-day window, you'll shift from information gathering to deep analysis and negotiation. By day 35, your financial advisor should have run detailed projections based on the community's costs, your Social Security income, IRA, or 401k withdrawals, and anticipated healthcare expenses. This is also the time to model different withdrawal strategies to minimize taxes, especially if you're considering a large lump sum payment for the entrance fee. Your attorney should be reviewing the contract line by line, paying special attention to refundability, exit clauses, and any language that could affect your estate or Medicaid eligibility. By day 45, you should be clear on what's negotiable. Perhaps you want a higher refund percentage, a cap on annual increases, or written guarantees on healthcare surcharges. Prepare a written list of your negotiation points, supported by your advisor's projections and your attorney's recommendations. Between days 45 and 60, begin formal negotiations with the community. This is your window of maximum leverage before you've signed, before you've transferred funds, and while you still have options. In my experience, communities are most flexible at this stage, especially if you present yourself as an informed, serious buyer with professional support. Don't be afraid to walk away if you don't get satisfactory answers or if the terms don't meet your needs. Remember, the cost of a hasty or ill-informed decision can be well over $234,000. Taking a few extra days to get it right is a no-risk way to protect your future. By day 60, you should have a final contract draft in hand with all negotiated terms included in writing. This is the time to double-check every detail: entrance fee refundability, monthly fee escalation caps, healthcare surcharges, and any promised services or amenities. Have your attorney review the final version before you sign. If you're planning to claim the medical expense deduction, ask the community for a written statement specifying what portion of your entrance and monthly fees are considered medical expenses for tax purposes. If you're using a trust or making gifts as part of your estate plan, coordinate the timing with your attorney and financial advisor to ensure all transfers are complete before you sign or fund the contract. Now let's move into the 60 to 90-day phase, which is all about execution and follow-through. Once the contract is signed, ideally around day 65 to 70, initiate your funding strategy. If you're making a large withdrawal from an IRA or brokerage account, work with your advisor to structure the distribution for maximum tax efficiency. For example, you may want to spread distributions across 2 tax years if the timing allows, or coordinate with your required minimum distributions, RMDs, to avoid unnecessary penalties. If you're claiming the medical expense deduction, keep meticulous records of all payments, statements from the community, and correspondence with your tax preparer. This documentation will be critical when you file your return next year. During this final phase, coordinate your move-in logistics, schedule movers, update your address with Social Security and your financial institutions, and notify your healthcare providers. If you have a long-term care insurance policy or Medicare Advantage plan, inform them of your new address and level of care to ensure seamless coverage. By day 90, you should be comfortably settled in your new community with all financial, legal, and tax matters squared away. Let's pause and recap your 90-day implementation timeline. Days 1 to 30. Gather contracts, assemble financial documents, schedule professional consultations, and request written answers from the community. Days 31 to 60. Deep analysis with your advisor and attorney. Prepare negotiation points, negotiate terms, and review the final contract. Days 61 to 90. Sign and fund the contract, execute tax and estate strategies, coordinate your move, and document everything for tax purposes. This structured approach isn't just about avoiding mistakes. It's about maximizing your leverage, protecting your savings, and giving yourself the confidence to enjoy your retirement community without financial stress. The sooner you begin, the more options you'll have, and the less likely you are to encounter unpleasant surprises. Let me repeat, this is educational content, not personalized financial advice. Your situation is unique, and the right timing can make all the difference. Consult with a qualified financial advisor and attorney to tailor this timeline to your needs. So far, you've built a rock-solid foundation, developed a clear timeline, and positioned yourself for success. But even with the best plan, you might encounter unexpected roadblocks, delays, disputes, or last-minute changes that threaten to derail your progress. Even if you follow this perfectly, you might encounter these common roadblocks. Part 7. Troubleshooting and Problem Solving. Overcoming the most common roadblocks to a secure retirement community move. Even with a rock-solid 90-day plan and the best intentions, it's important to acknowledge that the road to a financially secure retirement community move isn't always perfectly smooth. In my 30-plus years helping affluent retirees, I've witnessed how even the most diligent planners can encounter unexpected challenges, delays, disputes, or last-minute changes that threaten to derail your strategy. The good news is, when you anticipate these roadblocks and know how to respond, you can protect your savings, your peace of mind, and your future lifestyle. As always, remember, this is educational content, not personalized financial advice. Consult with a qualified financial advisor for your specific situation. No strategy can guarantee a perfect outcome, but being prepared for the most common what-if scenarios is a proven conservative way to safeguard your retirement. Let's start with a challenge I see all too often: delays or sudden changes in the retirement community's contract terms. Imagine you've spent weeks negotiating a favorable refund clause or a cap on annual fee increases. You're ready to sign, but at the last moment, the community revises the contract, perhaps citing new policies, market conditions, or legal updates. Suddenly, your refund drops from 90% to 75%, or the cap on fee increases is removed. This can be a gut-wrenching moment, especially if you've already begun planning your move. What should you do? First, pause and don't rush to sign under pressure. In my experience, the most successful retirees keep all correspondence in writing and calmly ask for a detailed explanation of the changes. If the new terms are less favorable, use your leverage. Remind the community of your negotiation history, your readiness to move, and your willingness to walk away. Sometimes, simply demonstrating that you have other options can restore your bargaining power. If the community won't budge, consult your attorney immediately. Sometimes a legal letter is enough to secure the original terms. If not, remember, it's better to delay your move than to accept a contract that could cost you tens or even hundreds of thousands of dollars over time. Another common roadblock is difficulty securing timely, clear communication from the community or your advisors. I've seen clients grow anxious when their calls or emails go unanswered, especially as key deadlines approach. This can delay your entire timeline and create unnecessary stress. The solution? Set clear expectations and deadlines from the start. When you request documents or answers, specify a response date. Please provide the full contract and all fee schedules by next Friday, April 14th. Do the same with your attorney and financial advisor. Can we schedule our review meeting by the end of this month? If you don't receive a timely response, follow up in writing and keep a paper trail. In my experience, communities and professionals who value your business will respond quickly when you communicate clearly and assertively. Now, let's address a scenario that's become increasingly common. What if your health changes unexpectedly during the process? You might experience a new diagnosis, a hospitalization, or a sudden need for higher levels of care, right as you're finalizing your move. This can throw your plans, your cost projections, and even your eligibility for certain contracts into question. Here's how to handle it. First, communicate openly with the community about your new needs. Many reputable communities will work with you to adjust your contract or move-in schedule. Second, revisit your cost projections with your financial advisor, updating them for the new level of care. For example, if your monthly fee jumps from $4,800 for independent living to $8,900 for assisted living, you need to know exactly how this impacts your cash flow and withdrawal strategy. Third, review your long-term care insurance and Medicare coverage with your advisor to see what's covered and what isn't. In some cases, you may be able to delay your move or renegotiate your entrance fee based on the new circumstances. The key is to stay flexible and prioritize your health and financial security above all else. A fourth challenge I often see is the what if of selling your current home or liquidating investments to fund the entrance fee. The real estate market can shift, closings can be delayed, or investment values can fluctuate. If you're counting on the sale of your home to provide $500,000 for a $350,000 entrance fee, but the closing is postponed or the sale price comes in lower than expected, you need a backup plan. Here's my advice. Build flexibility into your timeline and funding strategy from the start. Consider arranging a bridge loan, home equity line of credit, or short-term withdrawal from a brokerage account as a temporary measure. In my experience, retirees who have a contingency plan, such as a 60-day buffer between home sale and move-in, rarely face financial hardship, even if the unexpected occurs. Remember, it's always better to have access to extra liquidity than to scramble at the last minute. Let's recap the 4 most common roadblocks and how to solve them. First, if contract terms change suddenly, don't sign under pressure. Use your negotiation leverage, consult your attorney, and walk away if necessary. Second, if communication breaks down with the community or your advisors, set clear deadlines and follow up in writing to keep everyone accountable. Third, if your health status changes before move-in, communicate openly, revisit your cost projections, and adjust your strategy, prioritizing your well-being and financial security. Fourth, if your home sale or investment liquidation is delayed, have a backup funding plan so you're not forced to make hasty or expensive financial moves. Now, let's consider a few what-if scenarios you may not have thought about. What if, after all your due diligence, you discover a better retirement community option, one with better amenities, a more favorable refund policy, or closer proximity to family? The answer: don't be afraid to pivot, even late in the process. Your financial and emotional well-being are worth more than any sunk costs or time invested. What if a family member raises concerns or has a last-minute objection? Bring them into the conversation and review your plan together. Sometimes a fresh perspective can reveal risks or opportunities you hadn't considered. I want to emphasize again, this is educational content, not personalized financial advice. Every situation is unique, and the right troubleshooting strategy depends on your specific needs and goals. But by anticipating these common roadblocks and having solutions ready, you're taking a conservative, safety-first approach that has protected thousands of retirees from unnecessary stress and financial loss. So far, you've learned how to identify risks, build a clear timeline, and respond to real-world challenges with confidence. Once you master this foundation, you're ready for the next level, where you can truly maximize your results, scale your strategy, and ensure your retirement years are as secure and fulfilling as possible. Once you master this foundation, you're ready for the next level. Part 8, Next Level Actions, Maximizing Results and Future-Proofing Your Retirement Community Decision. Congratulations on making it this far. If you've followed along through the previous sections, you now have a deep understanding of the $234,000 retirement community financial mistake, how to spot it, avoid it, and proactively safeguard your wealth. But as I've seen over my 30-plus years guiding affluent retirees, the most financially secure and satisfied seniors don't stop at just avoiding mistakes. They take next-level steps to maximize every dollar, scale their strategies for changing circumstances, and future-proof their decisions for the long haul. Let me remind you, this is educational content, not personalized financial advice. Your situation is unique, and you should always consult with a qualified financial advisor before making significant decisions. But the advanced techniques I'm about to share are the same ones I've seen the most successful retirees use to turn a good retirement community decision into a truly great one that stands the test of time, adapts to life's curveballs, and leaves a legacy of security and confidence. Let's start with advanced contract optimization. Once you've secured favorable terms like a high refund percentage, capped annual fee increases, and clear healthcare surcharges, don't put your contract in a drawer and forget about it. Schedule an annual contract review with your advisor and attorney. Why? Because retirement communities sometimes update their policies, offer new packages, or change fee structures. The most successful retirees I work with revisit their contract every year, comparing it to current offerings and negotiating for upgrades when opportunities arise. For example, if your community introduces a new healthcare package that locks in lower rates for future care, you might be able to opt in or renegotiate. In one case, a client of mine saved over $40,000 in future care costs simply by switching to a new plan the community rolled out 2 years after she moved in. Remember, your leverage doesn't end once you move in. Staying engaged and proactive can yield significant savings over time. Another next-level action is to scale your withdrawal and income strategies as your needs evolve. At age 60 or 65, your withdrawal plan might be focused on maximizing Social Security benefits, minimizing taxes on IRA distributions, and carefully managing investment income. But as you age, your healthcare needs, spending patterns, and tax situation will likely change. The wealthiest retirees I've worked with revisit their withdrawal strategy every year, sometimes every 6 months, especially after major life events like a health diagnosis, the loss of a spouse, or a significant market shift. For example, you might switch from drawing primarily on taxable accounts to more tax-efficient Roth withdrawals if your income drops in later years. Or if you anticipate higher medical expenses, you might accelerate IRA withdrawals to take advantage of the medical expense deduction, as we discussed earlier. This dynamic, adaptive approach can add up to $25,000 to $50,000 in tax savings over a typical retirement and ensures you're never caught off guard by unexpected cash flow needs. Let's talk about long-term healthcare planning. Even after you've moved into your retirement community, your needs can, and likely will, change. The most successful retirees take a layered approach to healthcare. They combine Medicare, supplemental insurance, long-term care policies, and the community's own healthcare offerings to create a safety net that covers a wide range of scenarios. Review your Medicare plan every fall during open enrollment. If your community offers a supplemental health plan or a preferred provider network, compare its costs and benefits to your existing coverage. In my experience, retirees who actively manage their healthcare layers are far less likely to face devastating out-of-pocket expenses if their health changes suddenly. And don't forget to update your healthcare power of attorney and advance directives every few years. These documents ensure your wishes are honored and reduce family stress during difficult times. Now let's address scaling your estate and legacy plans. Many retirees focus on optimizing their contract and cash flow, but neglect to integrate these decisions into their broader estate plan. The most successful seniors I've advised ensure that any refundable entrance fees are clearly addressed in their will or trust. They update beneficiary designations on IRAs, Roth accounts, and brokerage accounts to align with their new lifestyle and living arrangements. Some even create charitable remainder trusts or donor-advised funds using the tax benefits of large medical expense deductions or appreciated assets to leave a legacy for causes they care about. This kind of integrated planning can minimize probate costs, reduce estate taxes, and ensure your loved ones receive the maximum benefit from your hard work. Another next-level consideration is ongoing scam protection and personal security. As you age, you may become more vulnerable to financial scams, especially those targeting retirement community residents. The most prepared retirees set up financial monitoring with their advisors, use trusted contacts on all major accounts, and regularly educate themselves about new scam tactics. If your community offers seminars or security resources, take advantage of them. I've seen retirees prevent 5- and 6-figure losses simply by having a second set of eyes on large transactions and by using multi-factor authentication on their accounts. Finally, let's talk about optimizing for flexibility and life's inevitable changes. The reality is that your needs, goals, and even your preferences may shift as you age. The most resilient retirees build flexibility into every aspect of their plan. They maintain a liquid emergency fund, typically $50,000 to $100,000, outside of their retirement community contract, so they're never forced to make hasty decisions or sell investments in a down market. They keep lines of communication open with family, advisors, and community management, so they can adjust quickly if an opportunity or challenge arises. And perhaps most importantly, they give themselves permission to reevaluate their choices every year, knowing that the best plan is one that adapts as life unfolds. Let's recap these next-level actions: annual contract reviews and negotiations, dynamic withdrawal and tax strategies, layered healthcare planning, integrated estate and legacy updates, proactive scam protection, and built-in flexibility for changing needs. Each of these steps is designed to maximize your results, scale your strategy for the future, and ensure that your retirement community decision is not just financially sound, but deeply satisfying and secure. Let me repeat for emphasis: this is educational content, not personalized financial advice. Always consult with a qualified financial advisor, tax professional, and estate attorney to tailor these next-level strategies to your unique situation. The sooner you start building these habits, the more options and security you'll have, not just for yourself, but for your loved ones and your legacy. So far, you've learned how to avoid the $234,000 mistake, implement a proven plan, troubleshoot real-world challenges, and optimize every aspect of your retirement community decision. But there's still one final step: bringing it all together into a comprehensive, actionable roadmap that will guide you for years to come. Get ready, because in the conclusion, I'll show you exactly how to put all these pieces together and move forward with total confidence. Over the past hour, we've covered a tremendous amount of ground together, more than most retirees ever learn before making one of the biggest financial decisions of their lives. You've invested your time wisely, not just for entertainment, but for real, actionable financial education. Let's quickly recap the 8 key insights we've explored. First, we identified the hidden risks and shocking statistics behind retirement community contracts, including how fees and refund clauses can quietly erode your nest egg. Second, we introduced the core solution, a structured, conservative due diligence process specifically designed for seniors with substantial assets. Third, we broke down the 5 essential implementation steps: obtaining full contracts, projecting costs, analyzing refund clauses, consulting professionals, and negotiating terms. Fourth, we revealed the most common and costly mistakes, such as misunderstanding refundability, underestimating fee escalation, overlooking care transition costs, and falling for high-pressure sales. Fifth, we dove into advanced strategies like leveraging medical expense tax deductions, optimizing withdrawal sequences, and using trusts or gifting to protect your legacy. Sixth, we mapped out a 90-day timeline showing you exactly when and how to move from research to negotiation to execution. Seventh, we tackled troubleshooting, how to handle contract changes, communication delays, health shifts, and funding hiccups. And eighth, we explored next-level actions: annual contract reviews, dynamic income management, layered healthcare planning, integrated estate updates, scam protection, and maintaining flexibility for life's changes. The knowledge you've gained could easily save you tens or even hundreds of thousands of dollars over the course of your retirement. In my decades of helping retirees optimize their finances, I can tell you, This represents decades of experience distilled into practical, real-world guidance. The most successful clients I've worked with consistently apply these principles, and what separates financially secure retirees from those who struggle is usually knowledge and implementation. Now that you understand each piece, here's how they work together. When you approach your retirement community decision with this comprehensive strategy, you're not just protecting yourself from a single mistake. You're creating a compound effect that safeguards your wealth, your independence, and your legacy. Imagine this: a retiree who follows this complete approach, meticulous contract review, professional consultation, optimized withdrawal and tax planning, regular strategy updates, typically preserves $100,000 to $200,000 more than someone who rushes the process or overlooks key details. For example, securing a 90% refund clause on a $350,000 entrance fee, capping annual fee increases at 3% instead of 6%, and maximizing the medical expense deduction can easily add up to $234,000 or more in protected savings and reduced taxes over 10 to 15 years. This is why wealthy retirees often outperform those with more starting capital. They follow proven systems, ask the right questions, and never settle for good enough. Let me emphasize this important point. Each strategy by itself is valuable, but together they create a powerful, resilient plan that endures through market cycles, health changes, and even legislative shifts. After helping retirees navigate multiple market cycles, I can tell you the real advantage comes from integrating these steps into a single, ongoing process. So, what can you do right now to put these insights into action? Here are 4 specific steps you can take in the next 30 days to secure your financial future and avoid the $234,000 mistake. First, in the next week, enter the assessment phase. Gather your essential documents, the full unabridged contract from your preferred retirement community, your latest tax return, and current investment and income statements. Calculate your current position using a simple net worth worksheet and identify your biggest opportunity area, whether it's refundability, fee escalation, or healthcare costs. Second, during week 2, move into the planning phase. Create a personalized timeline based on your age, health, and goals. Research the specific contract options we discussed. Look for communities with high refund percentages and capped fees. Document your current retirement strategy and compare it to the best practices you've learned here. Where are the gaps? What needs to be updated? Third, in week 3, schedule a meeting with a qualified financial advisor and an elder law attorney. Bring the contract, your cost projections, and a list of targeted questions, such as, what is the exact refund calculation? And how can I maximize my tax benefits? Verify that your advisor understands these advanced strategies and is willing to coordinate with your attorney and tax professional. Ask for a written summary of their recommendations. Fourth, in week 4, begin implementation. Start with the lowest risk, highest impact change, such as negotiating for a better refund clause or capping fee increases. Set up the systems and accounts needed to execute your new plan and begin tracking your progress with simple metrics: projected versus actual costs, tax savings, and contract compliance. Most importantly, take small, consistent steps. Don't let perfectionism or overwhelm keep you from making progress. Let me address some common concerns and set realistic expectations. Every financial strategy carries some level of risk, and there are no guarantees, only well-informed, optimized decisions. The goal isn't perfection, it's optimization based on your unique circumstances. Most successful retirees implement these changes gradually over 6 to 12 months, adjusting as life unfolds. Don't let the fear of making a mistake stop you from starting with small improvements. Remember, these aren't get-rich-quick schemes. They're proven, long-term strategies that build security, confidence, and peace of mind. You'll know you're on the right track when your financial stress decreases, when you have clear answers to the questions that used to keep you awake at night, and when you feel empowered rather than anxious about your retirement community decision. Measure your success by your increased confidence and by the clarity you bring to your family and future. Now, let's talk about community. By watching this, you're now part of a group of informed retirees who refuse to settle for average. The journey to financial optimization is ongoing. Markets change, laws evolve, and new opportunities arise. Continue your education by staying up to date on retirement planning developments, and don't be afraid to share your success stories. We can all learn from each other's experiences, and your insights might help someone else avoid a costly mistake. If you've already implemented any of these strategies, share your experience in the comments below. If you're facing a particular challenge, let the community know. Chances are, someone else has been there too. If this video helped clarify your retirement planning strategy, please give it a thumbs up. It helps others find this valuable information. Share your biggest takeaway in the comments. Which strategy will you implement first? Which concern is still top of mind for you? Subscribe for more in-depth retirement planning guidance. Each video is designed to save you thousands and bring you closer to true financial peace of mind. And most importantly, take action on what you've learned today. Your future self and your family will thank you for the wise decisions you make now. Let me weave in a few critical reminders as we close. This has been educational content designed to inform your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial, tax, and legal professionals before making significant changes. Past performance of any strategy doesn't guarantee future results. The tax implications we discussed may change with future legislation, so staying informed and flexible is essential. While this information provides a strong foundation, professional guidance is invaluable. A qualified financial advisor can help you customize these strategies for your specific situation. Tax professionals can ensure you're maximizing benefits while staying compliant. Estate planning attorneys can help with the legal aspects we discussed and ensure your legacy is protected. In closing, imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Sleep better tonight, knowing you have a clear plan for your financial future. Feel confident that you're making informed decisions about your hard-earned money. Your children and grandchildren will benefit from the wise choices you make today. Maintain your independence and dignity by taking control of your financial destiny. Your experience and wisdom, combined with these strategies, create a powerful advantage. The sooner you implement these strategies, the more time they have to work in your favor. Every month you delay is a month of potential optimization lost. The cost of inaction often exceeds the cost of making imperfect but informed decisions. Most retirees' biggest regret is waiting too long to optimize their strategies. You now have knowledge that many retirees never acquire. Use it to your advantage. What surprised you most about the strategies we covered today? Which approach best fits your current situation? Have you already implemented any of these ideas? Share your experience below. What's your biggest concern about retirement planning that we should address next? If you could ask a financial advisor one question based on this video, what would it be? Remember, the goal is progress, not perfection. Small improvements compound over time. The most secure retirees I advise didn't get there by accident. They followed proven systems, stayed engaged, and never stopped learning. Thank you for trusting me to guide you through this crucial decision. I look forward to hearing your success stories and continuing this journey together. Take action, stay informed, and enjoy the security and freedom you've worked so hard to achieve.